everybody, this is Meredith Dekker from Dekker Financial Services. So often we're asked what are some basic things with financial planning that we look at, and what really are they? Some people are embarrassed to ask what they are because it is a common term that they've heard, but yet they're really not 100% sure what they are. So we've started a series of videos that we would like to introduce you to. And what these videos are going to do is just ask some basic questions about different things that we look at in financial planning. One of the first things that we've looked at is 401ks. What is a 401k? Not everybody has a 401k, but what this product is it's designed for retirement, and it is typically designed to work with an employer. So an employer will set up a 401k plan. It doesn't have to be a large employer. It can be a small employer, even a single member employer. And they will set up a 401k plan. 401k is simply a term of the IRS. And what it means is that you are putting money away for retirement. Now, how do you do this? And it's all done through your paycheck. When you sign up for a 401k or are eligible for a 401k, then simply you contact your HR. There's various ways. Every department, every company may have a different process of signing up for these. And what you do is you say, okay, I want a certain percentage of my income to be put away for retirement. It's like a savings plan. Only you are putting this money into a special account, which is only intended to be used for retirement. When you sign up for an employment plan, typically there are certain times of the year that you can set up. So certain employers have enrollment periods, say in October, November, which is right where we're at today. And a lot of the people can make changes to their plan. Maybe they need to increase or decrease. Some plans allow you to do that all year round. Some plans say only one time a year. There's certain documents called the plan documents which control what's happening inside of a 401k. So some employers make it mandatory that you work there 3 months or 6 months or a year. Other employers say, no, you're eligible right away to participate. When you do participate, you sign up either online, which is what most employers are going to right now. They have an online enrollment period. And then that is when you get to pick what percentage of your earnings will go to the 401k plan. Now, where do these earnings go? Do they go off into La La Land? Do they go off into a bank account? No. They're normally put into what's called a custodian. Custodian is something like the bank you choose. You have a variety of different banks out there that you can choose to hold your checking account. Well, these different custodians, as they are called, will also are what you put your bank money into in your checking account, but there's usually one custodian that is selected by your employer to use to hold the funds. And there are a variety of them, different ones out there. I will name a few just to give you an example of what I'm talking about, such as Fidelity or TD Ameritrade or Vanguard. There's multiple different companies out there that you can use to put your money into. When that money goes into the account, then you will notice, for example, say if I elected to have 5% of all of my earnings put into a 401k, then every paycheck, 5% of all my earnings are put aside. Now the employer can also elect to match something. So typically they match maybe 3%, or they can match 5%. Some employers even match 10%. All of those different matchings have to be done for all the employees. So when somebody says, what does it mean to have to discriminate or to not discriminate, or that you cannot discriminate, it means that all the employees will have the same amount matched. So if I'm going to match 1% to you, then of your earnings, then I'm also going to match 1% to everybody else. So you can put more into it, but your employer usually specifies how much they will match. This is what I call free money. You don't have to work for it. All you have to do is put money away for retirement, and they will match what you are contributing. So it is money that is in addition to what you are earning. And I think this is probably one of the greatest benefits of a 401k. We also talk about why these contributions are considered tax deferred. So tax deferred means that if I put in $100, I am putting in $100. I am not paying taxes on that. Taxes can be withheld off of all of your paychecks. Usually, there's always some taxes that are withheld, and this amount of money does not have any with taxes withheld. So your $100 contribution is a $100 contribution, or whatever it is, what percentage it is, and that is non-tax. It's called tax deferred. Now, when you take this money out at retirement or after you're 59 and a half, then what happens is you pay all the taxes on that money. So the philosophy was, when a 401k was originally set up, is people would be in a lower tax bracket when they did retire, and therefore the taxes would be less. Now, that philosophy has been challenged in some ways, because if our tax rates go up, you may not be in a lower tax bracket. You also are required to take money out of a 401k after the age of 70 and a half. Then those are called required minimum distributions. So those are something that we'll talk about in another session. But after 59 and a half, you can take out as much money as you want to, whether you're working or whether you're not working. But if you are working for the same employer, that employer may restrict you how much you may take out. If you decide that you need the money out of your 401k before you reach the age of 59 and a half, you will pay a 10% penalty to the IRS because you took this money out, which was intended to be saved. When you invest into a 401k plan, there are limitations on how much you can put in. So this year, in 2019, you can contribute up to $19,000 if you're under the age of 50. If you are over the age of 50, you can contribute an additional $6,000 to that plan and up to the maximum amount. That gives you a lot of money that you can work with and a lot of leeway for you. So if you're only making $60,000, you might not want to put that much away, but it depends on what your spouse is making, and you will get the full benefit by putting the maximum away. I highly encourage high income W-2 wage earners to put the maximum amount into their 401k. How do you manage your 401k? So oftentimes you are able to log in to your account. Everybody will be able to see their individual account online, no matter who the custodian is. When you log in, you can see how much money has been contributed. Then you're going to be given options of where you can invest that money. So you can invest that money into mutual funds. Some plans allow you to put it into exchange-traded funds, and some companies also allow you to invest in their company stock. There are a lot of different ways, and this is where it becomes very important for you to consult with your financial advisor as to where you should invest that money and what the risk is to that money. Once you have decided where you want the money to be invested, then every time a contribution is made to your plan, a certain percentage will go to each allocation. So if you have 50% going into bond type funds and 50% going into equity type funds, which is like stock funds, then you'll be able to see that divided up, or whatever percentage you are advised with your financial advisor to do. And that all depends on your risk level. And that is something also we'll talk about later on in another session. When you also go into it, it's so important that you reallocate, you rebalance from time to time. These are all discussions that are dependent upon what your risk level is, and it's how aggressive do you want to be. I usually recommend that younger people be very aggressive, and the closer you get to retirement, the more you back off on that aggressiveness. And that is where it's very important for you to talk to your financial advisor. How do you become vested? So vesting, it means that if you leave that employer, you can take all of the money with you. You always can take all of the money with you that you have contributed. That is always 100% vested. Oftentimes in the plan documents, an employer will have a vesting schedule, it's called. If it's a straight 401k, many times there's no vesting schedule, but there is an additional portion which is called a profit share, which could be vested. So in other words, your employer would match you a certain percentage, and then if the company did well, they may voluntarily put in a certain amount or portion or profit of the company into another, into the same account, but it's labeled a little bit differently. When that happens, often there's a vesting schedule with that. So in other words, you would have to stay at the company, for example, 6 years before you would be able to take 100% of the profit sharing portion out with you. Normally, when you leave a company, you will take that account and you'll either move it over to another employer's 401k. You can also leave it in there if the plan documents allow, or you can move that money to an IRA, which is an individual retirement account. There are no penalties for any of those, no 10% with penalty from the IRS or anything like that. Are there 401k fees? Yes, there are. And this depends on who your employer is, on how much you pay. You will see recently, in the last few years, it has been mandatory by the Department of Labor that shows on your statement how many fees you are actually paying. Now that is only for having the plan. Internally, when you invest in a mutual fund, for example, there are additional fees that can be charged to that account. So for example, if you invest in an American Fund's capital growth fund, that fund itself may have some internal fees. Now, in order for you to find out what those are, you need to dig a little deeper, either into the prospectus, which normally is posted on the website, or they will mail you one. But they are required by law to reveal that information to you. Typically, a 401k plan is very cheap. It's very low cost to you because the funds are not they're typically in what's called an institutional fund, which means that they don't have marketing fees and that type of thing attached to them. But there are still some management fees that you may be charged. So that is a consideration that you need to discuss with your financial advisor also. When can you withdraw the money? As we discussed previously, you can, at any time you leave your employer, you can roll it over. Or if you're after 59 and a half and you've quit working, you can then start taking what's called distribution. Then you will pay the tax on that money that is in your traditional IRA. Inside of your IRA, many employers now are also adding another feature, which is called a Roth 401k. A Roth 401k means that you are not getting a tax benefit this year when you put the money in. There's no deduction, no with taxes, that taxes are still withheld. So you may have $100 contribution, but you're really, what you see contributed into your account would be the equivalent of $90. And the reason for that is because you're paying the tax on that money. But that money grows tax-free, and there is no required minimum distribution at 70.5. And when you take the money out, whenever that is, after the age of 59.5, you do not need to pay any taxes on that money, which is a huge advantage to what you're doing. The biggest thing to remember is that even though this is an employer plan and a 401k plan, it is very important to discuss it with your financial advisor. How you're invested, how you're allocated is very important to discuss to make sure that your whole plan is consistent with what your goals are. Thank you for spending some time with us today. We appreciate it.